Hello and welcome to your daily note for September the 14th, 2022. So, yesterday we received the inflation readings and both came in higher than expected. In fact, your core inflation rate, removing food and energy, was up 6.3%. The forecasted estimate was for 6.1, and the prior month was for 5.9. So, an acceleration in core inflation, while we did see a continued deceleration in the headline number. However, that headline number came in above the forecasted estimate. The actual number was 8.3%. The forecasted estimate was for 8.1, and the prior was for 8.5. We're going to spend a lot of time in here because the market reacted pretty negatively to the CPI print. I think everyone expected it to come down. Our model showed 7.93 on the headline number with an upper forecast of 8.4. And so this print, although being lower, it still highlights that upper forecast. Just real quickly, if I could go back to that forecast from yesterday. So let's jump in here. You can see how 8.49 was our upper forecast. So that hits the upper end of the range. And the 6.3 is above the upper forecast as well. The reason why this is so important is the deterioration going forward from here is going to be extremely important to getting back to 2%. You can see if that we continue to hit this upper end of the forecast, even though it's declining, you're going to have an 8 handle by the end of the year, and that is not sufficient for the Fed to call victory and to quit raising interest rates. So let's dig into the CPI report that I've pulled up here. So again, just real quickly, it was a 0.1% month over month increase in the month of August. Again, that's an 8.3% increase from a year ago. The increases in shelter, food, medical care indexes were the largest contributors to this month, but that was offset by the 10.6% decline in gasoline index. However, food continued to rise, increasing 0.8% over the month. And electricity and natural gas also increased. And I really want to highlight those. You know, food at home has been accelerating for some time now. It seems like every single month you're getting a higher and higher print, which gets you to almost a 13.5% inflation rate on food, which is running well above the overall inflation rate at 8.3%. Electricity. We do know that Europe is in an energy crisis. The U.S. is not immune to natural gas prices. Natural gas prices have ballooned, and so have utility bills, now up almost 16% from a year ago. Shelter continues to be a key driver as well, up 6.2%, and services up 6.1. We highlighted this in our August update. If I could flip back here for a second. If you haven't got a chance yet to review that, I highly recommend you taking some time to flip in there. On the inflation side, we looked at the consumer price index for electricity, food at home, shelter, and services, and you can see how there's not really a sign of decline in any of these. As long as the natural gas prices remain high, electricity will remain a problem. Natural gas is also a big component of fertilizer, so that could keep food prices, at least at the grocery store, higher. And then services and shelter continue to be elevated as well. So, you know, that just leads to this sticky inflation problem. Now, we did get relief, as the report said, from fuel prices. Fuel prices came down almost 10%. That's the second consecutive month of a decline. And so that's also hopefully bringing down the overall fuel prices. And you've probably seen that at the gas pump. So as consumers get relief in one area of the economy or in one area of this inflation basket, they're getting hit on another area. And I think that's very critical and very important for us to take note of. So all in all, the year-over-year numbers coming down. Remember, the year-over-year number was 9.1 just a few short months ago, then 8.5, and now 8.3. So there is this decline happening. However, the core, after you strip out the food and energy, which is really volatile, continues to accelerate. So again, this is a report that highlights the fact that the Fed can continue to raise interest rates. It's a big reason why you saw the 2-year spike to 3.75, the 1 year getting close to 4%. the 10-year even jumping to 3.42. And this acceleration in the 10-year led to some sell-offs here in the bond market. The only place in the bond market that really didn't move was the long end, 3.5. The 30-year is holding pretty steady there. We have seen people kind of creep in and start to buy that here over the last week. So you are going to hopefully get into this situation of where does the Fed stop? I'm still in the camp that they're probably going to do 50 or 75 in September, another 50 or 75 in December, and then see what demand destruction has occurred after raising interest rates so rapidly. This will definitely change people's opinion with hitting the upper end of the forecast. It's going to be much stickier as we've been expecting, and it's going to be much more stubborn on the way down, which continues to reemphasize the fact that we have to remain defensive and we have to remain cautious, maybe holding a little bit more cash than normal, and even on the equity side, focusing on utilities, healthcare, staples. And then pick your spots on the yield curve. Right now, the shorter end of the curve makes the most sense, as you don't get crushed by the weighted duration call. If you haven't seen our weekly business cycle model, the fixed income side still allocates a very small 20% to the fixed income side. So given that low fixed income weighting, you can tell that the risk is still very high, even though we're in this environment where fixed income should start to give you some negative correlation. We've been seeing that it unfortunately continues to be positively correlated with the S&P, creating these really tough periods, these tough sell-off periods. To speak on those tough sell-off periods, you can actually look at the Z-scores, and you can see that this was almost a 4 standard deviation downside day. We don't get very many of those. Actually, if I come down here and you look at some of the just the model ETFs, so AOM is the moderate model by BlackRock iShares. You can see that was a 1 standard deviation day. You don't get very many of those, and you got to go back to COVID to get to a -2 standard deviation day. The conservative portfolio almost hitting -1 standard deviation as well. The growth portfolio going through 1 and approaching 2. Again, you got to go back to COVID to get one of those days. And then the aggressive growth did go through 2 standard deviations. And then again, you got to go back to COVID to see periods like that happen again. The last time that we got that, June, the June lows of June the 16th, that was the last time that some of these model portfolios here hit those lows. So it's definitely something where this large standard deviation day highlighted the surprise in the CPI report. It usually is something that I like to look at along these data points. This tells me that the market was offsides. They thought it was going to come down much faster. They thought this would lead to a quicker Fed pause, and that's unfortunately just not the case. Even though it's coming down at a slow pace, and I think that truly is what matters here. Moving into the rest of the week here, you're going to get your producers price index today, month over month. Right now, the prior was for -0.5. The forecasted estimate, let's flip over to Estimize real quickly to take a look here. Estimize has it at 0.22. Ours is coming in a little bit lower at -0.1. So just a continued deceleration, maybe a little bit of an improvement here. Your highest estimate is 0.95. Your lowest is -0.44. So you do have a pretty wide spread or a wide range there. What's interesting, this rapid reduction over the last month made it really difficult to forecast. So here is the Ppi Monthly Average. The gold that you're seeing here is the actual time series itself, as we registered a -0.5% in the prior month. This blue line that you're seeing here is the fitted model estimate. And then, of course, this gray shaded bar going forward is our forecast. Again, you can see this decline. Minus 0.1 is the lower end of the forecast, which is why we've estimated it there. But you can also see the uncertainty of this forecast. This large move has made it difficult to forecast, and so the uncertainty here is going to be quite wide. But one of the things that gives us at least some hope is looking at Fed survey data alongside core inflation and headline inflation. Let me show you that real quick. On the PPI side, we're going to look at prices paid from the Fed survey data of Texas, Philadelphia, and New York. In blue, you can see how that's rolled over pretty hard. And that's been a pretty good signal that the PPI, CPI, and then the core inflation rate are going to roll over as well. And that's what we have been seeing. So as long as the Fed survey data continues to roll over, we're going to continue to hit these on the downside here as we continue to estimate them. So with that, later on in the week, you're going to get even more economic data that's going to highlight the demand in the economy. You're going to get the New York manufacturing Fed survey data. You're going to get retail sales. You're going to get the Philadelphia Fed manufacturing survey data, industrial production, consumer sentiment, initial jobless claims. There's just so much coming out this week that I would imagine the market's going to be on pins and needles as we get more and more data. A lot of this data gets released tomorrow. So you might get some repositioning today in anticipation of what some of this information coming out might look like. Again, we're going to just continue to reiterate our defensive stance. There's nothing in the economy that makes me think things have changed. Again, I highlighted that in our August review. If I go back real quickly, yes, the economy has somewhat flatlined on the coincidental indicators, but when you look at the leading indicators and even the Fed survey data, you continue to see a deterioration in growth. And the leading economic indicators tell us what's coming next, right? It's a big reason why they are called the leading indicators. And so, we're sticking with those for now. Those hard data and even the soft data are confirming more slowdown to come. And so from that, I think it just makes continued sense to play defense on the equity side, take a lower fixed income position like our optimization has been recommending, 20% or so, and then continue to have a cash allocation until this environment changes. So with that, I think this is a great place for us to stop. If you have any questions at all, don't hesitate to leave us a comment, shoot us an email. We'll be happy to answer those. We'll be back again tomorrow with updates from the PPI and the housing market index that gets released today from NAHB. And then we'll also bring you an update on what we're seeing in the Fed surveys data, as well as industrial production later on in the week. So we hope everybody has a great Wednesday, and we'll be back again tomorrow with another update.